Hello everyone, welcome back to the channel. Today we are going to study the first chapter of auditing, and that is basic concepts of auditing. So in this video we will be studying the first and second subunits of this chapter, that is nature, scope, objectives and significance of auditing, as well as brief introduction to auditing standards. So let's get started. So first let's know the evolution of auditing, and the first one is ancient origins and early histories. So the concept of auditing were back in the period of 3600 to 3200 BC, and the initial focus was mainly done for public accounts, and this was done by ancient Egyptians, Greeks and Romans, and this was evident in the 12th and 14th century. Then its formalization and professionalization. So in 1494, auditors were officially appointed to check the public accounts, and in 1949, Luca Pacioli published on double-entry bookkeeping and auditing. And the Industrial Revolution led a massive increase in the volume, type and size of business transactions, thereby necessitating the concept of auditing by an independent person. Next one is institutional development. So in 1866, the Exchequer and Audit Department was created by the Act of Parliament in England, and in 1870 the Institute of Accountants in India was formed as a society in India, and in 1880 the Institute of Accounts got a royal charter and was turned into the Institute of Chartered Accountants in England and Wales. The next one is legal and regulatory milestones in India. So the Mauryas, Guptas and Mughals used these accounting and auditing, and in 1857 the first legislation relating to companies in India, the Stock of Companies Act, and all these acts introduced the provisions of annual audit. In 1930, the Companies Act 1913 made the audit compulsory, and in 1956 Companies Act, it was made that the audit is compulsory and to ensure that independent professionals are acted as statutory auditors. And in 1956, which brought amendments to the Income Tax Act 1961, it was placed the concept of cost audit into practice. And now let's talk about the recent changes, that is post 1991, that is after 1991. So the Companies Act 2013 was revised, and it was influenced by technological, economic and social changes, and that is liberalization, globalization, etc. Now let's study the concept and definition of auditing. So what exactly is auditing? And this we are going to discuss here. So the concept of audit has undergone continuous change over the period, and hence it is required that the meaning of the term audit is analyzed both in the traditional, that is narrow, and modern, that is in the broad sense of the term. So first let's see the narrow perspective or the traditional view. So the word audit is derived from the Latin word audere, which means to hair. So it simply means to get authenticating rights to the records and thereby ensuring the accuracy and reliability of the financial statements and reports. So it is simply the investigation of statement of figures involving examination of certain evidence to enable an auditor to make a report. So the auditor has the right to evaluate the records and make his opinion on that. The second term is the broader perspective or the modern view. So here the concept has changed from mere authentication to an independent appraisal activity, and this extends itself towards evaluation of non-financial aspects as well. So, as per Standards on Auditing 200, that is Basic Principles Governing an audit is an independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form. Now, let's see the essential features of auditing. So, the first one is evidence evaluation. So, this involves evaluation and verification of the relevance, reliability, and adequacy of evidence. So, there must be supporting verifiable informations in the form of vouchers, documents, and explanations, and the auditors evaluate these and make the report. The second one is systematic review. So, it is analytical, critical, and investigative review of the accounting and internal control. And the third one is scope of information. So, this information can be financial or non-financial. There is nothing that it should only be financial. The fourth one is standard criteria. So, there must be standards or criteria for evaluating the information. Only then we can analyze the result. The fifth one is auditor quality. See, the auditor should be competent and independent. So he should also be qualified and should have the prescribed qualifications and should have a certificate of practice. So only then he is considered as a good auditor. The next one is the objective or outcome. So it ensures reliability of information and authenticity of assertions in the financial statements to enable the auditor to form an opinion on the true and fair view of the state of affairs and profit or loss. Okay, now let's see the nature and scope of auditing. So, according to IASB, that is International Auditing and Assurance Standards Board, the objective of the audit is to enable the auditor to express his opinion on whether the financial statements are prepared in all material respects in accordance with an identified financial reporting framework. So, as per IASB, an auditor should express his opinion and he should check whether the financial statements are prepared as per the financial reporting standards or frameworks. So, the auditing information need not be necessarily be accounting. So, however, information must be in a verifiable form. So, that is just the criteria, and there should be standards for evaluating the results, as well as the auditor must be competent person but should also have an independent mental attitude. Now, let's see the relationship between accounting and auditing. So, the first one is nature of work, and accounting is the process of collecting, classifying, and summarizing of data and thereby making financial statements. And auditing is the analytical and critical examination of the books, records, and the financial statements prepared. The second basis is timing. So, accounting transactions are recorded at the time of occurrence, and the auditing is post-mortem examination of the recorded transactions. And the third basis is objective. So, accounting measures business events, records them, and communicates the financial results. And auditing here reviews financial records to form an opinion on the authenticity of the financial statements created by the accountants. And the fourth basis of difference is responsibility. So, here the responsibility of the accountant is towards the shareholders or owners to ensure financial statements can be prepared. And in case of auditing, the responsibility of the auditor is that of an independent person, that is, he can review the financial statements and give his opinion. And the fifth basis is reporting. So, in case of accounting, it is not required to review or report on the financial statements, but to report the compilation of records to the management. And in case of auditing, it is required to submit a report with his opinion on true and fair view assertions made in the financial statements. The sixth basis is employment. And in case of accounting, the accountant works for the management. And in case of auditing, the auditor is an independent person and is accountable to the owners or shareholders and not to the management. The seventh basis is liability, and there is no liability in case of pure accounting, and in certain cases in auditing the auditor could be held liable to the third parties. And the eighth basis is maintenance. So it may not be mandatory for small individuals or partnership firms to create accounts, and in case of auditing it could be exempt for various individuals or small partnerships but is statutory requirement under many laws. And the standards of accounting is the Indian Accounting Standards or INT AS, and in case of auditing, that is standards on auditing. The next topic is audit versus investigation. So audit is nothing but independent and systematic examination of the evidence, and it is to ascertain whether the financial statements are true and fair. And investigation, on the other hand, is the examination of accounts and records, and it is for a special purpose, and this varies from assignment to assignment. So now let's see in depth. So now let's see the scope of audit and investigation. So the audit has wide scope, that is like statutory audit, internal audit and management audit. But the scope of investigation is specifically defined, or the period or areas to be covered. And the third basis is objective. So audit is to certify the truth and fairness of the financial statements, and investigation, the objective is to ascertain a specific fact or special purpose. That means, is it a fraud or for half yearly results, etc. And the fourth basis is procedure. So audit is conducted in accordance with the generally accepted auditing principles, and investigation involves an extended auditing procedure. Now the fifth basis is evidence. So auditor draws conclusions primarily on persuasive evidence, and investigator draws conclusions on the basis of substantial or sometimes conclusive evidence. And the sixth basis, approach. So the auditor is skeptical and not suspicious, that is, he starts with confidence. But an investigator is suspicious, that is, he starts with suspicions. And the seventh basis is periodicity. So audit is a routine exercise that is normally conducted annually, and the investigation may spread over a period longer than an year. The next topic is scope of auditing, and it is as per Standards on Auditing 200. So the overall objective is to enable the auditor to express an opinion on the financial statements in all material requirements. So he should ensure reliability and sufficiency of information, and the preparation of financial statements are in accordance with the underlying accounting standards and statutory requirements. And in case of judgment, the auditor's work shall involve an exercise of judgment concerning items that are individually material or as a group. And the evidence basis, the auditor is not expected to rely solely on record verification, but must be satisfied with the authenticity of the transactions, appropriate recording in the books. So the next topic is basic principles governing an audit. So the Institute of Chartered Accountants of India gives some basic principles that govern the auditor's responsibility whenever an audit is carried out. And so in our ICMA study material, there are 9 points, and I divided them into 3 sub-points. So the first one is personal or ethical principle, and under that there comes integrity, objectivity and independence. And so the auditor must be straightforward, honest, sincere and free from any influence or interest. That is, he should maintain impartiality. The second one is confidentiality. the client's information should not be disclosed to anybody without permission or regulatory requirement. And the third one is skills and competence. The auditor must be performed by adequately trained, experienced, and competent person. The second subpoint is execution principles, that is, the work performed by others. The auditor must carefully supervise the work delegated to the subordinates, experts, etc., as the auditor remains responsible for the delegated work. And the fifth one is documentation, that is, proper working papers must be maintained to evidence the audit work and demonstrate adherence to the basic principles. The sixth one is planning. The auditor should obtain knowledge about the client's business to determine the nature, timing, and extent of procedures. The seventh one is audit evidence. Here, the auditor must obtain sufficient appropriate audit evidence through compliance and substantive procedures. The next one is accounting system and internal controls. So, an understanding of the accounting system and the related internal controls helps in determining the nature, timing, and extent of audit procedures. And the last one is audit conclusions and reporting. So, on the basis of the conclusions drawn from the audit evidence obtained, the auditor should give unqualified report, that is a good report, or a qualified report, that means with some sort of issues, or adverse report, or the disclaimer report. So the next topic is objectives of auditing. So here there is overall objectives of the independent auditor and primary and secondary objectives. So the first one is the overall objectives of the independent auditor. So it is mentioned as per the standards on auditing 200, and he is required to obtain reasonable assurance that the financial statement as a whole are free from material misstatements, and the report on the financial statements, and he should communicate as required by the standards on auditing. So here in the accordance with the auditor's findings. The auditor is not in a position to primary and understand whether it is a good one or a bad one. Primary objective, the main objective, is to determine whether the financial statements present a true and fair view of the financial position and performance of a business, and the balance sheet should show the financial position on a particular date. The profit and loss should show the financial performance during the whole financial year. So the next one is secondary objectives. The auditor is responsible for detecting frauds and errors in the books of accounts and financial records. So this is known as the secondary objectives, because the primary responsibility of the auditor is to safeguard the business assets which rest with the management. And the third one is collateral or ancillary objectives. That is, in the process of achieving the main objectives, an audit should also attain certain collateral objectives, such as it should protect the shareholders' interest, and it should stop the evasion of taxes, and should safeguard against capital erosion, and there should be fair return for the investors, and reasonable price to customers, fair compensation to workers, and complying with policies regarding social corporate responsibilities. The next topic is significance of auditing. That is, auditing is an important process because it ensures the reliability and credibility of financial reports, which benefits all stakeholders such as owners, creditors, and regulators. So from legal point of view, let's see the significance of auditing. Filing of income tax returns. So the tax authorities generally accept the profit and loss account and do not go into the details of the accounts, provided they have been prepared by a qualified auditor. The second one is borrowing money from external sources. So banks and other financial institutions often sanction various loans on the basis of the audited financial statements. So if the statements are not audited, there will be many issues in connection with taking loans. The third one is statement of insurance claim. So insurance companies may settle claims for loss or damages based on the audited accounts of the previous year. And the fourth one is sales tax payments. So here the audited books of accounts are generally accepted by the sales tax authorities. And the fifth one is action against bankruptcy. The audited accounts serves as a basis to determine action in bankruptcy and insolvency cases. The next one is from the point of view of internal control. So the first point is quick discovery of errors and frauds. So auditing helps to detect errors and frauds at an early date. The second one is moral check on the employees. So auditing keeps the accounts clerk and accountants regular and vigilant. That is, as they know that the auditor will complain against them if the accounts are not prepared up to date of their. If the next basis is from external affairs point of view. First one is settlement of accounts. Audited accounts facilitate the settlement of accounts of a deceased partner. Next one is valuation of assets and goodwill. So if the business is to be sold on a going concern basis, the valuation of assets and goodwill is made easier because the accounts have already been audited by an independent person. The third one is future trend of the business. So it can be assessed easily with certainty from the audit books. And the next topic is advantages of audit. First one is protects interest. So audit is a tool that allows different stakeholders to protect their interest in the enterprise. Second one is it prevents misconduct. That is, it serves as a moral check on employees to detect defalcations or embezzlements. The third one is vigilance. Employees within remain alert and vigilant regarding the updating of books of accounts and other records. Next one is reliability for government. Audited accounts are considered more reliable by government departments. And efficiency facilitates detection of wastages and losses and helps in instituting corrective actions. The next one is financial assistance. Financial assistance methods like banks, financial institutions, and government require audited accounts before granting any financial assistance. And the last advantage is dispute resolution. That is, audited accounts are helpful in the settlement of accounts between partners and thus avoiding any dispute among them. The next topic is inherent limitations of an audit. So as per standards on auditing 200, the objective of an audit is to express an opinion on the true and fair view of the financial statements. So this opinion is not an assurance as to the future viability or efficiency of the enterprise. So an audit does not guarantee that all material misstatements will be detected due to the following inherent limitations. So the nature of auditing. First one is test nature of the audit. That is, the auditor samples transactions and not every single one. The second one is persuasive evidence. That is, the audit evidence is often persuasive rather than conclusive in nature. The third one is internal control limitations. So inherent limitations of internal controls means the management may be in a position to override the controls. Now let's study some of the basic concepts related to auditing. First one is professional skepticism. So this term is an approach that ensures the auditor maintains an attitude that something is wrong is detected. So this helps in identifying misstatements from fraud or error. So this requires the auditor to question material misstatements, management's representation, and accept records or documents as genuine only if there is evidence to the contrary. The second one is materiality, and this is the fundamental concept in auditing. So materiality means important cost-wise, profit-wise, effect-wise, or value-wise influencing economic decision of user. So what is a material in one circumstance may not be a material in another circumstance. The next topic is classification of auditing. So why do we classify? And this is because different organizations have unique characteristics, and the audit approach depends on the organizational structure, purpose and frequency of auditing and verification methods. So the basis of classification is divided into five, that is organizational structure wise, objective wise, priority wise, scope wise, and subject matter wise. So the first one is organizational structure wise classification, and under this there are two types of audit, that is statutory audit and non-statutory audit. So first let's start with statutory audit, and this audit is required by law or statute, and this ensures proper checking and reporting of company accounts, and this is mandatory for companies under applicable statutes. For example, Companies Act 2013 mandates audit of accounts, reporting, etc. And government bodies are audited by CAG, Controller and Auditor General of India. And insurance or nationalized banks are governed by IRDAI or RBI and other statutory acts. Cooperative societies are governed under Cooperative Societies Act 1912. The next one is appointment of the auditor. So appointed by shareholders or the central government in some cases, and the qualified chartered accountant with a valid certificate of practice is only appointed as an auditor. Now let's see the advantages of statutory audit. First one is it provides an independent opinion on the truthfulness and fairness of financial statements, and it ensures no misstatements or misrepresentations. And the third one is it enhances credibility, reliability, and authenticity of financial data. Now let's see the uses of audit opinion. So the shareholders use audit opinion for informed decision making and voting. The tax authorities use audit for timely tax assessments, and buyers or sellers use this at the time of purchase or sales, and the partnership forms the audit report for settlement on retirement, admission, or death of a partner. Courts use the audit in disputes involving employees, creditors, or debtors. And valuation of businesses or shares during mergers and acquisition. Loan approvals by banks, investors, and financial institutions. Grants and tax benefits for non-profit organization, and internal control evaluation identifying weaknesses in systems, and management oversight verifying fund usage and policy adherence, and accuracy assurance ensuring no understatement or overstatement of income or expenses, and profit distribution calculating profits for dividends and bonuses, and legal compliance ensuring statutory adherence, and government claims which helps in settlement of subsidies. The next topic is non-statutory audit, and this is the second type of audit under organizational structure wise audit. So this is conducted without legal requirement and usually voluntary or as per internal rules. So the auditor is appointed via mutual agreement defining scope, rights, duties, etc. So this is common for sole proprietorship, partnership, NGOs and societies, associations, hospitals, etc. So now let's see the advantages of non-statutory audit. And here we are going to discuss the advantages for sole proprietors as well as for partnership firms and others. So first we are going to discuss the advantages of auditing for sole proprietors. So this improves internal control, this enhances reliability and accounts finalization and tax assessments. This encourages ethical behavior among employees, and it gives easier access to loans from financial institutions, and as well as this helps in settling disputes. And in case for partnership firms and others. It helps in setting accounts among partners and protects the interest of sleeping partners, minors, and partners not involved in daily operations. And auditing helps in goodwill settlement during admission, retirement, or death of a partner and builds trust with banks and financial institutions for loans. Now let's see the difference between statutory audit and non-statutory audit. So the first basis is legal compulsion, that is statutory audit is compulsory and non-statutory audit is voluntary. The second basis is scope. The relevant statute or law determines the scope of work in case of statutory audit, and in case of non-statutory audit, the employer or partners determine the scope of work. The third one is qualification of auditor. So in case of statutory audit, the qualifications are prescribed, and in case of non-statutory auditor, there is no qualifications prescribed. Fourth one is power, rights and duties of an auditor. So the statute describes it in case of statutory audit, and in case of non-statutory, the right powers are all involved in the agreement between the auditor and the client or the firm. The fifth basis is independence, and in case of statutory audit, the auditor has independence in status and in mental attitude. But in case of non-statutory audit, the auditor does not enjoy such independence. And the sixth basis is auditor's liability. So here, in case of statutory audit, the auditor is liable for negligence under the common law, and in case of non-statutory audit, the auditor is liable for negligence only under the common law. And the seventh one is publication of audit report. So in case of statutory audit, the report is published for the public, and in case of non-statutory audit, the audit report is made known to the employees or partners. The second basis of classification is objective wise classification of audit, and there are two types under that, that is internal audit and independent audit. So in case of internal audit, so here is a continuous and critical appraisal, and it ensures objectivity and consultation and helps in early detection and prevention of further damage. In case of independent financial audit, a qualified auditor at the request of a client is conducting the audit, and it helps to comment on the truthfulness and fairness, and it may be compulsory under some acts which govern the entity. The third basis is periodicity wise classification, and there are three types of audit under periodicity wise, that is periodical or final audit. Second one is interim audit. Third one is continuous audit. So let's study each one of them in detail. So periodical audit is conducted at the end of the accounting year after the books of accounts have been closed. So this does not interrupt regular accounting. An auditor may be statistical sampling methods to save time. So the advantages are this is cost effective and ensures focus and non-interference with accounting work. And the limitations are it is difficult to be responsible, and it delays as well as it reduces the responsibilities of detecting all frauds and errors since it is conducted at the end of the period. The second type of audit is interim audit, and this audit is conducted between two annual audits. So the audit conducted between two annual audits is known as interim audit, that is for example quarterly or half yearly. The purpose is the declaration of interim dividend and valuation of shares. So this is carried out by professionals but has no legal status as figures may be altered later. And the uses of interim audit is that it helps to ascertain of interim profit or loss, as well as change in structure of partnership firm, determining goodwill and net worth, and investigation of any suspected fraud and obtaining loans from financial institutions. So the third type of audit under periodicity wise classification is continuous audit, And so this is done continuously throughout the year, and this becomes an integral part of modern auditing at many levels, and technology is a key to enabling this approach. Now let's see some of the basic features of continuous audit. So this is conducted throughout the year. The frequency is regular or irregular intervals, and the focus is 100% transactions, and it enable technology as well as the detection is it provides advance notice about errors and irregularities, as well as surprise visits by the auditors are involved. And the necessity of continuous audit is where internal controls are inadequate, transactions run in large numbers, and management is interested in getting statements of accounts audited periodically for better resource management. So the next one is advantages of continuous audit. It helps in early location of errors and frauds and quick rectification at early stage, and it provides guidance to clients, finalization of accounts and moral check on employees, as well as improves statutory auditors focus. The next topic is demerits of continuous audit, and now let's study the difference between continuous audit and periodical audit. So there are 11 bases of difference, and the first one is timing. So continuous audit is conducted throughout the year, and periodical is conducted after preparation of final accounts. So continuous audit is expensive and periodical audit is less expensive. The detection of frauds in case of continuous audit are detected early, and in case of periodical audit the frauds and errors are detected very late. And the scope, continuous audit has detailed checking is possible, and in case of periodical detailed checking is not possible. The seventh basis efficiency of the client's staff. So this in case of continuous audit it improves the efficiency of client's staffs, and in case of periodical audit the staff may become lazy and inefficient and keeps the work pending. Collusion. So in case of continuous audit there is a possibility of collusion between audit staff and employees, and in case of periodical this is hardly any possibility of collusion. And the ninth one is moral pressure. So since the audit staff is continuously engaged in the organization in case of continuous audit, there is moral pressure, and there is no moral pressure in case of periodical audit. So continuous audit is applicable for large organizations and periodical are for small organization. And the last basis, that is report. The continuous audit facilitates timely submission of audit report, and periodical audit takes time to prepare and submit the audit report under periodical audit. Now let's see limited review. So under periodicity wise there are 4 types of audit, that is periodical or final audit, second one is interim audit, third one is continuous audit, and the fourth one is limited review. So as per the clause 33 of SEBI regulations 2015, a listed company must submit its quarterly, year to date and annual financial results to the stock exchange, and the auditor has little time for a thorough examination or a full-fledged audit, and this process makes the auditor a restricted study of books and other documents, and the scope of limited review is substantially narrower compared to an auditor, and the generally accepted auditing standards are not followed in a limited review. Now let's see the fourth type of classification, that is scope wise classification of audit. And there are 3 types: complete audit, partial audit and detailed audit. The first one is complete audit. So here the scope is not confined to specific limits, and the auditor is required to check all possible aspects of business, and this is non-feasible to conduct a complete audit. So the second type of audit under scope wise classification is partial audit. So this is a non-statutory audit that restricts the scope to checking certain specific aspects only. So the limitation is that the auditor may not be allowed to obtain information outside the defined scope. And the third type of audit is detailed audit or audit in depth. That is, it involves checking of transactions from the time of their recording till their final effect. And so, in every stage a transaction goes through is clearly examined by the auditor using various audit evidences. And the last classification is on subject matter wise. So, there are 12 types of audit under subject matter wise classification, and the first one is cost audit. So this simply involves the examination of cost books, cost accounts, cost statements and supporting documents. So this represents true and fair view of the cost of production and involves checking the appropriateness of the cost accounting system. The second type of audit is management audit, and this covers all areas of management controls like planning, organizing, coordination and control. So this is a forward-looking, independent and systematic evaluation for improvement of organizational profitability, as well as it improves to help the efficiency of the management. The third type of audit is operational audit, and it examines all the operations and activities, and this brings efficiency and economy and formulation of plans and checking the implementation of systems and controls in respect of other departments. So the next or the fourth type of audit is tax audit, and this is the examination of financial records to assess the correctness of taxable profit calculation and ensure compliance with the Income Tax Act. And Section 44AB of the Income Tax Act 1961 mandates certain class of taxpayers to get their accounts audited by a chartered accountant. So, the aim of tax audit is to ascertain compliance with the income tax law and fulfillment of requirements of the income tax law, aiming to stop tax evasion. And the fifth one is social audit. That means there is a need to examine and measure how far the business has been able to discharge its social responsibility. So, sixth type of audit under subject-wise classification audit is proprietary audit. So here, this is the independent and systematic evaluation of the appropriateness of management decisions based on public interest, financial discipline and behavioral standards. So the main objective is to ensure and safeguard of funds, check misappropriation of funds and misutilization of delegated authority, and increase managerial productivity. And the seventh one is forensic audit. So this examination of legalities by blending technique of property audit, regularity, investigative and financial audit. So the objective is to find out whether or not true basic values have been reflected in the financial statements to examine if any fraud has taken place. So the eighth type is performance audit. So an independent assessment of an entity's operations to determine if specific programs or functions are working. So the purpose is to serve the fundamental purpose of government accountability. And the ninth type is secretarial audit. So this is relatively a new concept recognizing the growing complexity of corporate laws. So the goal is to assure the corporate body that the legal requirements have been duly complied with and in time. So the next type of audit is human resource audit or HR audit. So this is the method of objective and systematic verification of current HR practices, documentation, policies and procedures. So the HR auditor can be internal or external. The next type is Information Systems Audit or IS audit. So an organizational function that evaluates asset safeguarding, data integrity, system effectiveness and system efficiency in computer-based insurance system. So part of more general financial audit that verifies an organization's accounting records in the computer is what this IS audit is all about. Now let's see the factors leading to development of IS audit, and that is consequences of losing data resources, possibility of misallocating resources, possibility of computer abuse, and high value of computer hardware, software, and personnel, and high cost of computer error, and need to maintain privacy of individual persons, and need to control the evolutionary use of computers. And the last type of audit under subject matter wise classification is the environmental audit, and this is an excellent management tool for relating productivity to pollution. So this is the examination of the accounts of revenues and cost of environmental and natural resources and their estimate, depreciation and values recorded in the books. Now let's study the second subchapter of the sixth chapter, that is brief introduction to auditing standards. So now let's see what are the standards of auditing or SA. So this is the well-defined guidelines followed by auditors in conducting an audit. So the source is, it is formulated by professional bodies of accountants based on input from stakeholders, that is from industry, regulators and academy. And the goal is to provide principles and techniques to be followed to improve the quality of the audit work. Now let's see the purpose of standards. So this acts as a ready reference, and this reduces audit risk, as well as this allows an auditor to defend himself against negligence allegations and improve the quality of audit work and restore public trust in the profession. And the next one is Internal Auditing and Assurance Standard Board, IASB. So the origin, it is established by IFAC, and that is International Federation of Accountants, and the objectivity is to bring harmony to the profession on an international scale. And the function is that the independent standard setting body under the auspices of IFAC, and the goal is to serve public interest. Now let's see what is Auditing and Assurance Standard Board, that is AASB as per ICAI, that is the Institute of Chartered Accountants of India. So ICAI is one of the founder members of IFAC, and the role is to actively propagate pronouncements of IAASB and contributes towards global harmonization and acceptance of IAASB standards. And the evaluation is that the APC was converted, that is the Auditing Practices Committee was converted into Auditing and Assurance Standards Board in July 2002. Now let's study the objectives and functions of the Auditing and Assurance Standard Board, that is AASB. The first one is review and identify gaps. So review existing and emerging auditing practices worldwide to identify areas where new standards are needed. And the second one is formulate standards. So AASB formulates engagement standards and standards on quality control, and this is under the authority of ICAI Council. And the third one is revise existing standards. So AASB revise the existing standards and develop guidance notes and formulates clarifications on necessary issues arising from standards, as well as issue guides like technical guides, practice manuals, studies and other papers for the guidance of professional accountants. Now let's study the structure of pronouncements issued by AASB. So there are engagement standards, that is ES, and the standards on quality control, that is SQCs. So the engagement standards, there are four types, that is standards on auditing, that is applied to the audit of historical financial information, and standards on review engagement, that is applied to review of historical financial information, and assurance engagements applied to assurance engagement other than audit and review, and related services which involve agreed upon procedures, compilation and other related services. And standards on quality control, that is SQC, the applicabilities, these are issued to be applied for all services covered by the engagement standards. And in addition to the above, the AASB also issues statements on auditing, general clarifications and general notes. The next topic is procedure for issuing standards on auditing. So let's see the steps. The first one is identification and prioritization. So the AASB, that is the Auditing and Assurance Standard Board, identifies the areas where auditing standards need to be formulated and it determines the priority for their selection. The second one is preparation of draft. So AASB is assisted by study groups or task force. So these groups prepare the preliminary draft of the standards. The third one is exposure draft. So based on the group's work, an exposure draft of the proposed statement standards is prepared by the committee. So this draft is issued for comments by members of the ICAI, that is the Institute of Chartered Accountants of India, as ICAI is mentioned in the context of the AASB. And the next step is finalization and submission. So after considering the comments received, the AASB finalizes the draft and the finalized draft is then submitted to the council. So next is the issuance by council. So the council reviews the draft, makes suitable modifications in consultation with the AASB and issues the standards or statements under its authority. And let's see the key consideration. While formulating standards on auditing, the AASB also takes into consideration the international standards on auditing, that is ISA, issued by the International Auditing Practices Committee, that is IAPC. So with this, here we are concluding this video. Until next video, keep learning and keep growing. Thank you and have a nice day.